Guys, you're all very welcome. I really do hope that you get something out of this evening. And today, really, what we're trying to do here is give you simple tips. There's nothing that you probably don't already know or probably don't have already heard, but sometimes just somebody poking at you again, reminding you. It's basic steps, guys. And the whole idea is to give you a little bit of money confidence. So we deal with people that have money, we deal with people that don't. But the idea today is really, well, where do you start? And if you have started, how do you sort of boost that? So a little bit about us. My name is Pascal. I own a company called Advice First Financial. I've been advising in the financial arena and advising clients since 1992. I decided to go out on my own and formed Advice First Financial. We started in 2005. Guys, we're members of all the groups that you would expect us, trusted financial advisor groups, Life Assurance Association. We advise on all aspects of financial planning, right from mortgages, savings, investings, protecting your income and all that. So today, guys, really what we're trying to do here is get your act together. I changed that. I know Jay was doing a bit of advertising with a different word, but anyway, act. We'll use act today. So what we're talking about is financially getting your act together. And the goal for me is to help you set financial goals to create financial security. It also creates peace of mind, though, because if your finances are in a good place, suddenly your peace of mind also can help on that rate of going. So, how do we do this and how do we start? So, first thing we're going to do is help you build a plan that you can actually stick with. How do we do that? And this is sort of where we need to start is we need to organize your finances and regain the control of it. Because sometimes people feel that their finances are out of control and they don't have any control, and it's just that they don't have the right system or the right way of thinking about it. We're going to look at reducing debt and making smarter money decisions. And we're also going to create a habit or show you how to create this savings habit. And that's really what it's all about, is creating good financial habits. There is tools available. If you want some of our tools after this is over, we'll take you through what's available. If you want, just get in touch with us, give Jay a shout. We're happy to share anything that we can help you do this, like budget templates, like how to create, how to claim tax reliefs, all of those sorts of stuff. So there's lots that we can provide. Just let us know what you're looking for. Okay, so what do you start and how do you start with this? So we've got to start like any journey. We've got to understand what's happening. So we start with understanding, but most important is you have to be honest with yourself. And when I sit down with clients all the time, trying to get to the honest about their finances can be difficult because we are all easy on ourselves when it comes to what we're doing with our money. And we can be a little bit economical with the truth. We've got to know what's coming in. That's quite easy to figure out because you're getting your paycheck every week and every month, so you know what's coming in. More importantly, we've got to understand where's it going. So what is going out and where's it going to? And again, we've got to be honest. So how do you actually do that? First thing to do is sit down with your bank account. Sit down with a template. And again, we can give you apps. We can give you all sorts of templates around figuring all of this out. The best advice I can give is we'll send you a paper template. Get a pen, get a pencil, and write this stuff down. Because if you're typing into a box in a spreadsheet, it doesn't go into the head. But if you're physically writing it down, working it out on a calculator, these things sink into your head better. And what we're trying to get to is consciously managing your money because we all unconsciously spend money. We tap our money. We start on a Monday morning and you've got 30 quid in your pocket, and by Wednesday morning, there's a tenner left. And a lot of the time, we can't answer where we spent that money, and that's unconsciously spending money because we're tapping. So the whole idea of it is get a handle of the bank accounts and go through it. See where you're spending the money. And it's not really about stopping your habits, it's about understanding them. And then you make informed decisions as to whether or not you want to continue to save or continue to spend that money that way. Next one is claim all your tax credits. Everyone has got this. So this is a tax credit certificate. And what we're trying to talk about here is you're going to get your finances in order, but you've got to make sure that you're not leaving money behind you. And lots of people don't know how to, don't remember to, don't want to, or are afraid to go into their revenue account. But you go in and you take a look at the certificate for 2026 and you see what your tax credits are. You can see, well, actually, this is mine. And you can see that the personal tax credits is here. Now, if I was paying a pension, if I was paying salary protection, if I was claiming carer's allowance, if I was getting tax relief for anything else, it would be presented there. And incidentally, before anybody says, well, why aren't you paying a pension and why aren't you doing salary protection? I have it all done through my company, so it doesn't form part of my personal tax funds. It forms part of the company package that I've got. But you should, if you're paying salary protection yourself, it should be shown here. If you're paying a private AVC, a pension contribution should be shown here. Some of the common ones that we see people missing, again, now obviously assistant dog allowance and all that sort of stuff, you need to figure out whether that applies to you. But a couple that apply to nearly everyone is health expenses. When you go into your revenue online and you look at the tax credits that are available, these pop up. And if it's relevant, you've got to claim your tax relief. So health expenses, medical insurance, flat rate expenses, those are things for, if you're in a certain occupations, you get flat rate expenses. Nurses, doctors, healthcare workers, civil servants, even tradespeople get flat rate expenses. Big one for us, personal retirement savings accounts, additional voluntary contributions into your pension, and what they call permanent health benefit, that is salary protection. And what we find is we help people set these up originally, but then you've got to keep an eye on them every year to make sure revenue continue to tick them over for next year. So we set all our customers up in 2025. 2026, we have to remind them to go and check because revenue, for some reason only known to revenue, decided that they weren't going to tick them across to 2026. So suddenly you're still paying your contributions. You should be getting your tax relief, but they decided not to give it to you. So you've got to get into a habit every January of checking exactly what you've got and don't leave money behind you. Now, I'll caveat this to say, listen, I am not a tax expert. I am a financial advisor. Tax isn't my area of expertise. I have a working knowledge of taxes. If your taxes is any way complicated or you want a help from a tax advisor, we're more than happy to recommend people that we work with quite closely in cases where taxes are a little bit more complicated. But generally, guys, if you're a PAYE worker, if you're self-employed, you'll have an accountant, but everybody should do a tax return every year. Whether or not you owe them money or whether you're not, just go in and check and see, are you getting everything that you're entitled to? And don't leave money behind you. When you're trying to get a handle on your monies and seeing, listen, where can you save money and how do you get control of your money? One of the big ones we'd say is shop around. We all buy in products and services. We all buy in electricity. We buy in our utilities. Shop these around, guys. There is numerous websites out there that'll help you do that. And do not sit with the current provider. Chances are you're not getting the best price unless you're shopping around. When it comes to mortgages, people have an idea that you're with your mortgage advisor or you're with your mortgage provider and you need to stay there. That is not true. There's a list of all the mortgage companies in Ireland. All of these companies compete and all of these companies offer deals. So the idea is really shop around. Now, again, there's websites out there to help you do this. We are more than happy to shop around as well if you want to get in touch. And all we really do is we look at what you've got and say, well, listen, is there an option to save some money? And what we're trying to get to is how do we create wealth? So if we're going to create wealth, let's figure out that we're not spending it. And the easiest way to create wealth is not spend it. So if you can cut down on the household expenditures and the cost of running your life, that gives you more money to do something with. So shop your mortgage, guys. You do not need to stay with your current provider, but obviously look at the terms and conditions before you go off gung-ho to sort of, I'm going to do this. Talk to somebody first. If you don't know whether there's an option, speak with somebody, give us a call, talk to your own broker. Make sure that you're not biting your nose to spite your face here. With your mortgage, big one, are you on a fixed rate? If you are shopping around, Check in with the provider that you've got with your mortgage. Are you on a fixed rate? If you wanted to get out of that rate, is there a cost? Is the first question. And then ask your existing provider, well, listen, what are your rates? Is there something better than you're offering me? A couple of examples. Fixed rate mortgages are now as low as 3%. I've looked at a mortgage on Monday and the rate was actually 4.9. When we did the analysis, we were able to save them somewhere about €92 a month just by shopping around. And suddenly that helps them guys. They were planning to save for their children's education. That gave us an extra 90 quid before they were even out of pocket. That was just savings on the mortgage alone. Another company, Avent, have an interesting product. They have a full term, what they call a one plan or a one mortgage. They can lock the rate in at 3.4 for as long as you want. Fixed, done. You know exactly what your rate is going to be for the rest of the mortgage. They're the only company in Ireland doing that kind of, like I'm talking 25, 30, 27-year fixed 3.4% done. So things like that are out there. And especially if you're trying to plan your finances, if you're able to lock down your mortgage payment, and what happens over the years is your wages increase, your mortgage payment is stuck. It's done. So it becomes more affordable as the years go by. It allows you now to make firm financial decisions because you know exactly what your mortgage is going to be. They also offer a tracker type product. Now, it's not a tracker that we were used to in the past. It's a Euribor tracker, but it's a tracker-ish product. And that's a 3.7% variable rate. Again, only provider in the market doing things like this. So there are options, guys. Shop around, get information. As well as that, everybody's got life insurance, everybody's got pensions, and we don't look at these things. But things like, Royal London are offering great discounts at the minute. Zurich are offering discounts on some products. Aviva are offering discounts on products. So if you've got, life insurance, salary protections, price about, make sure you're getting value for money. Some people were smokers when they took their life insurance out. They're now not smokers. That can make a huge difference. You may have been loaded because of a health issue when you took out your contract. Maybe that issue is now abated and you may be able to get better terms. So it's hugely important to shop this around. When it comes to pensions, look at the pension charge and structures. And what we're trying to do is we're organizing your finances and again, gaining control of what's happening to you when your money. Pension charges can be massive, especially if you're doing additional voluntary contributions, say for civil servants, if you're doing them through wages deduction, they hide a lot of charges in there, which depletes your wealth because they're taking money to pay fees rather than actually giving you returns. So guys, shop around. Everything can be shopped. Just seek out help if you don't know how to do it. By all means, reach out to us. We're more than happy to help. Reach out to your broker, sit down and have a chat with them, guys, and put them under pressure to see, listen, what does this look like? Reducing debt. I would akin this, guys, to a hole in a bucket that you're trying to fill with water. If you're trying to save your money, but yet and all you're paying high interest on loans and paying debt, it's kind of counterintuitive. So firstly, let's get a hold of the debt. Let's understand exactly what this is. So list it out. What's the balance? What's the repayment? How long is left? If you're struggling to manage your money on a monthly basis, this is hugely important. When does it come out of the bank account? What's the date? You've got to understand this to sort of get ahead of it. Can these be restructured? Is there better terms? Is there better rates? Things like credit card debt. Is there somebody out there that you could transfer it to for 6 or 12 months without interest? Transfer it over, get it paid down. Things like that are hugely important and can be done. There are some very simple little things and moves that you can make to help reduce the debt burden. And you always start with, first of all, the most expensive debt. Let's look at that first. Shop it around, guys. See, is there a better option out there to actually look at this debt? Start and pay down the most expensive debt first. People always ask me, Pascal, I've got extra money every month. Should I pay down my mortgage? And I'm saying, yeah, but you have a car loan that's a lot more expensive. You've borrowed money at 4% on your mortgage, but your car loan is 9%. Why would you pay down your mortgage when it's the cheapest money you've got? If you're not saving, then paying down debt isn't a great idea. Get your emergency fund in place first. and then look at debts. So again, it depends where you are on your savings or your wealth creation journey as to what you should do with your debt. But paying down your mortgage is not always the first place to run. Money needs a purpose, guys. And this is about creating save-its habits. So you've got a hold of your budget. You've managed to shop your utilities. You've looked at your mortgage. You've cut the fat out of that. You've got it as good as it can be. You've looked at your life cover. You've looked at your pensions. You've looked at all your financials and you did a deep dive and a stock take on it. Now you're getting to the point of, okay, we now understand how much we can save. We need to now figure out, well, what are we going to save? And the first thing is you've got to give money purpose, good purpose. Because if you don't, it'll find its own purpose. And many times have we set off in January and said, yeah, let's do this. And by March, it's gone because we didn't give it a purpose. So then you created a purpose for it. There's a wedding coming up. Oh gosh, I've got €1,000 in my bank account. Let's book a weekend away. Let's go for a spa day. I want to get my nails done. I want a new pair of clothes. I want a new suit. We give money purpose, but let's give it a purpose that builds on what we're trying to achieve when it comes to a bit of wealth creation and peace of mind. You need to establish your short, medium, and long-term goals. Examples of a short-term goal: my car insurance is due every November. So rather than panic in October and have to come up with 700 quid or 1,000 quid, well, what would happen if we saved it month on month and week on week? Short-term goals. I'm going on holidays and I want to, I need 2 grand. Those are short-term goals. Medium-term goals: if you can get to a point where you're saving to change your car rather than borrowing to change your car every 3 to 5 years, much better. Long-term goals: children's education. So your child is 2, going to college, you want to save for longer term, saving for your retirement, saving for your pension. Those are all long-term goals. And they need to be different ways of actually handling those. Most people spend and then they try to save. My advice is to turn that around. Your savings should be a bill the same as your ESB bill or paying your mortgage. Once you establish how much that figure is through all the work that you've just done, then you put that away first and then you spend. And now you're saving and then you're spending rather than the other way around. Other big trick: automate the decision. Decision is made how much we're doing every week or every month, and then do that. Automate it. Do not try to make that decision 12 times a year. Or if you're paid weekly and want to do this weekly, every week. Do it once. Automate it. And then keep it in sight. Keep it under review. Whatever your decisions are, keep it out of your eye line. Keep it out of sight. Do not look at your bank account and say, oops, I've got €1,000 in there. Let's go nuts. Get it away. Get it out of sight. For short-term goals especially, if you remember what your granny used to do, when I started in insurance, I used to go around collecting premiums and the cost of insurance. I used to go around fortnightly to houses collecting money to pay for their insurance. And when you get into houses, a lot of people had wee jars. A lot of them were above the fireplace, and you had, for the insurance, you had the milkman, you had the coal man, and everybody had a wee jar, and they dropped their money in every week to pay the bills as come up. For short-term savings goals, this is a brilliant analogy and it's a brilliant way to do it. And your granny had it right. That's exactly the way to do it. Now, what we call jars above the fireplace now are called vaults. Now, we all know who and what we're talking about here. A lot of the online banking have these vaults. And I'm not recommending one bank over another, but the analogy of how you save for short-term goals, this is exactly it. Break it down. Car insurance, holiday, getting this done, that done, whatever it is, set up a little jar, put the money in. Money is there when it's needed rather than you panicking to gather the money up when the time comes. Long-term goals, guys, they need a different strategy. And they need to be invested rather than sitting on deposit. Short-term goals, you're not going to make an awful lot of money on them, but certainly if you're putting money away for a longer period of time, we need to combat the effect of inflation. And I'm going to show you a couple of examples around this. But let me explain what inflation actually means if I can. If I told you that the money, whether it's 100 quid in your pocket, whether it's 10 grand in your bank account, whether it's 100 grand in your pension, none of this money has any value. It has absolutely no value in itself. Strange thing to say. What gives money value is the products and services, and what you can do with it gives money value. And we've all know about the cost of living and how much is going up. So if you take the cost of living, this is inflation. So if we imagine, and it's pretty close, that inflation in Ireland and in Europe at the minute is about 3%. That's telling us that the cost of everything is going up by 3%. So if you have invested money and it's not going up by 3% a year, well, the actual purchasing power of your money is depleting. And that's how money works, guys. Inflation will eat the face of money. I'm going to show you a couple of examples around this. For long-term goals, it's hugely important that you automate them. Whether it's a standing order, direct debit, whether it comes out of your bank account, whether it comes out of your salary, take advice around that, but get it automated. Make the decision once and keep it under review. Do not make the decision 12 times a year, 52 times a year. Do not make this saving decision every week. This is not, you'll break down. Make it once you understand your numbers, and then keep it under review. So let's look at this effect of inflation, guys, to give you an idea what this looks at. So this is thanks to ChatGPT, I give it what I wanted and it gave me this, and it's very colorful, but it gets the effect of what I wanted. And I wanted to show you what 10,000 euros over 10 years, what that looks like if inflation was just sitting at 2.5%. Now, what we're talking about is the purchase power of money. And if you can use the analogy that you take 10 grand today and you stick it under your mattress, and it sits there for 10 years, and you come back in 10 years' time and you reach for the money out of the mattress and you go to town to buy whatever you're going buying. What you'll find is that what you could buy with the money, the 10 grand today, is a lot different than what you can do with it in 10 years' time. And with a 2.5% inflation, the actual purchasing power of that money is 7,800. So if we were to equate that today, instead of having 10,000 today, you have 7,800. And that's just with inflation. And that's how money works. Unfortunately, if you don't get a decent rate of growth in there, your money's actually, now you'll still have 10 grand in 10 years' time, but the actual what you can do with it and what you can buy in, the value is only 7,800. Now, conversely, if we were to add in a little bit of growth, what difference does that make? And this is why this is hugely important for longer term savings. So let's say your son, your daughter is 4 years of age and you want to fund for their children's education, let's say for college fund, and they're not going to need the money till they're 18. So you have 14 years to save this money. Well, if you put 140 euros away this month, in 14 years' time, you can see what inflation is going to do to it. So what we've got to do for longer term savings, and what I mean by longer term savings, I would say anything over 5 years. Get an investment structure rather than a saving structure. Do not have this money sitting on deposit. I've done exactly the same calculation here, only I've factored in a growth rate of 7% a year. We start off at 10 grand. Now, in 10 years' time, the likelihood is that that money will look like 20 grand. There is a factor of 7 in math that tells you your money on a 7% growth rate will double every 10 years. But I'm not chatting about the actual number. I'm chatting about the purchasing power of the number. Yes, the number will be a lot more, but the purchasing power in today's terms in 10 years' time is 13,000. So instead of having 10 grand that is now worth 7,800, you'll have the equivalent of 13,484. Your number will be higher, but it has the purchasing power of 13,400 because we've factored in a 2.5% inflation. So guys, it is hugely important for long-term money that we invest rather than save. Obviously, there's good bit of advice around investing and saving. And that's where you do need to sit down with an advisor and work this through. And I don't care whether you've got 10 grand or 100 quid a month or £1,000,000. Principle is exactly the same. So, in summary, when it comes to setting financial goals and how do you stick to them, you've got to understand the money's in and money's out. That's basic. And we've got to work on conscious spending rather than unconscious spending. There's a coffee shop across the road from us. And I see the same people, the same time, every time morning, going in, tap, 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 cup of coffee, cup of coffee, cup of coffee. We sat down with a couple a couple of weeks ago, and we went through the bank account. We were trying to get a mortgage organized for them, and we were trying to help them save for the deposit. And when we actually analysed their bank account, we worked out that they were spending roughly about €35 a week on coffee. They didn't have a clue because I asked them what was all the tapping going on. Coffee, 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 coffee. And it's not that you stop living your life and drinking a cup of coffee, but suddenly now they made a conscious decision as to whether they wanted to continue spending 35 quid a week on coffee or not. And that's what I mean by conscious spending. Because once you're conscious of it, you will make different decisions. Most people spend and then they try to save. Turn this around, guys. Save and then spend. Figure the number, set the goal, you know exactly what it is, and then you spend what's left. And by the way, saving everything you've got is not the answer either, because there's no point having a great life when you're 65 and retired if you can't go for a bottle of wine and a pizza and take the kids for holidays. It's about balance. And that's where a bit of thought, a bit of work, this can happen. And I don't care, guys, whether you're on 100 grand a year or 25 grand a year. The budget is the budget. Let's work out. And I don't care whether you save 5 quid a week. If that's where you need to start, then start there. Start at whatever level you can, because it's really about creating the habit rather than the number. You can kick on the number and you can increase the number. It's the habit. Automate the decision and get it away out of sight. Do not look at your bank account every day and see your savings. Because as soon as you have a wee lump sum in there, if you haven't given that purpose and given it a name, that's for Johnny's education, that's for the car insurance. If you haven't given it a name, you'll take it and you'll give it something else. You'll be away down the street. You'll have a night out. You'll be away for a weekend. You'll be away to get your nails done. Away to the spa. You will give money purpose. So give it a good purpose. For short-term goals, set up your jars analogy, like Granny used to do. Modern day version vaults. We've done that. You've seen that. 100% great idea. Longer term goals needs an investment strategy. You need to sit down and you need to get ahead of inflation, guys. Having money on deposit is not a good idea for long-term savings or creating wealth. Guys, that's really the presentation, but I thought maybe what we'll do is there's a few questions that I get asked all the time. And I want to go through a few of them, and then Jay, if there's other the guys are asking, you can come back in and we'll go through some of those as well. But let's run through some of the common ones I get all the time. How much should I aim to save each month? And it's a brilliant question. And this is a very personal the answer is very personal because it's based on you. It's based on where you are in your life. It's based on the cost of running your life and obviously the amount of money coming into the house. So as a rule of thumb, I would say if you can start with 5% of what you're bringing in, ideally you want to get to maybe 20%. But if you haven't done it and you're trying to start, I don't really care where you start. If you work it out and say, listen, I can afford €5 a week, then start there. But the point is that you make it that it's worth doing. And your worth doing could be €5 a week. Other people could be 500 or 600 quid a month, 1,000 quid a month. It's all relative. But the point is understand it and start somewhere. And then increase it, and then increase it, and build it up and build it up. It's the habit that you want to get to. I have extra money. Should I pay down my mortgage? Again, we get this one quite a lot. Should you pay down your mortgage? It's not the first thing I would run to. And I do think you need to sit down and maybe have a think about this. Sit down with a financial advisor and go through this. The issue I've got with paying down your mortgage is once you put the money into the house, it's very hard to get the money back out. So I have a lot of people want to pay down their mortgage, but they're not funding for children's education. They're not funding for retirement, or they haven't put salary protection in place to make sure that their income is going to continue. And I would say if all of those things are sorted, and the last thing on the agenda was paying down the mortgage, maybe. But it's certainly not the first thing that I would do because there's a lot of other things going to happen in your life that you're going to need money for. And if it's paid down on the mortgage, now you're going to reach into the mortgage and remortgage the house to pay this debt. And guys, I do this all the time. I have people over 60 and over 70 years of age that we're doing finance for because they're living longer, their pension wasn't as good as it ought to have been. And now we're trying to get finance for them to help them out to live out their life. I'm remortgaging houses for parents to try and put kids through college. So paying down cheap money on a mortgage isn't always the first place I would go. Now, in saying that, if your mortgage is giving you sleepless nights, if it's costing you mindfulness, if this mortgage is keeping you up at night, then speak with an advisor. And if the answer to that is that you pay this down, then absolutely pay this down. But do it more for that because it's not great money management, but emotionally, if that's what needs to happen for you to have peace of mind, and peace of mind trumps good financial advice. I don't care what good financial advice looks like. Your peace of mind is much more important. But make sure you're doing it for the right reasons, guys. Should I save or pay off debts? Kind of answered that one. Very quickly, save your emergency fund first. So don't start paying down debt if you don't have a few quid in the bank account, because what will happen is you're paying down the debt and the washing machine breaks down. Now you're taking more debt. So have your emergency fund. If you have never saved or haven't saved, start with an emergency fund. And then when you have that, start and look at paying down debt. Emergency fund, if you haven't had any, try getting 1 week in there. Now, what I mean by that, if you earn 300 quid a week net, try getting 1 week ahead of yourself. Try getting 1 month ahead of yourself. What you want to try and do is get at least 2 months of your net income as an emergency fund, and also have all your direct debits paid for the month before the due. So have enough sitting in the bank account to pay all those down. So you kind of have your money a month ahead of yourself. So realistically, it's 3 months' money that's there, that's for your emergencies, that's keeping you right. What's the fastest way to pay off credit cards without going broke? Don't borrow in the first place. Credit cards are the worst thing that you could have. They are an absolute disaster of a yoke if you're not paying down the debt every month. If you're paying the debt every month and you're using credit cards as a way of financial control or financial wealth, but make sure you pay them off. If you've got debt, look at maybe transferring it to somewhere that'll do maybe 6 months interest free to transfer the balance over to them. And once you do that, cut the feckin' thing up. If you've got a mortgage, if you've got a credit card balance and you can't get out of debt, stop fucking using it. Get rid of it. Cut it up. Start and work on the debt. Should I prioritize high interest debt over small balances first? Good. Another great question. I mean, we'd always say look at the high interest debt first, but if there's a small balance there and there's 500 quid left and you're paying 100 quid a month and you've got extra dough, get rid of that one first out of the way. Tidy it up and then work on the next one. So if it's very small debt, get rid of them and then work on the more expensive. But obviously, if it's substantial debt on both, start with a higher interest debt first. How much of an emergency fund do I really need? 2 months of your net income as a minimum. But if you haven't any, start with one. And when you get one, work to two. But definitely 2 months. And ideally, what you want is if you know that your mortgage and your credit and your utility bills and all your expenses, let's say, is €1,500 a month, then you want to have €1,500 a month in your account that pays all the bills. So your account isn't zero, it's 1,500 quid. And what that means is that all your bills for July are sitting in your account in June. It doesn't mean that you've got 1,500 quid. It just means that you've got the money there to pay the bills when they're due. That way you don't get any late charges, any misdirect debits. you're pushing a month ahead of yourself. So that's my alarm away off, guys. I am going to stop, Jay, and I'll stop sharing. And you can, if we have any questions, by all means, throw them at me.
Amazing. No, we do have quite a few very interesting questions. I think
Okay.
some of those you covered already.
Okay.
Things like how much would like be sufficient for an emergency fund. You said it's about like 2 months or so.
Mhm.
Um, let me see. Let me work through all the questions. There's a lot
Okay.
of really good questions here. A question here: would you set up a pension over investment fund? Like, is there any advantage and disadvantage to each? And does pension growth outweigh annual inflation? How's that
Okay. So
scenario?
again, it comes back to the financial goal. So if the financial goal, and this is where you might have medium and long-term goals. So let's say your long-term goal is that you want to have X amount of euros at age 65. And if you're saving for retirement, the best way to save for retirement is through pension accounts, tax relief, investment growth, tax free, all of those things. If you're saving for shorter term saving, like I need to fund college or I you have something that's needed before retirement, then obviously don't put it into a pension because pension is exactly that. It's designed to give you an income in retirement. And what you're doing is you're using your working years and you're taking money out of the money now to fund when you're not working. So if you're saving for retirement, pension. If you're saving for anything else, an investment.
Oh, awesome. Another question here. We have two big credit union loans instead of a mortgage, and living in the house for about 10 years. Should we look to get a mortgage instead of our loans? Like, so I imagine like to replace the loans.
Again, guys, when we get questions like this, we don't know the full story. Um, my advice is investigate that. Sit down with a good advisor. They will take you through, and it's not a right or wrong answer. What they'll do is they'll work through what does a mortgage actually look like, and how much is the repayment on that. What is the overall cost of that? If that makes your life easier and it helps you release money and gives you more money in your pocket and it gives you more peace of mind, then absolutely, 100% do that. Credit union loans, kind of expensive. Mortgages is the cheapest money you're ever going to buy. So I would say sit down, let's get all the information on the table and then make an informed decision as to whether that's the right idea. But if you can get cheap debt that pays off dear debt, in theory, that should be a good idea.
Awesome. And just wanted to note, like, if you guys want any help after the webinar, you can just go to our website, advicefirst.ie, and there you can, fill out a contact form, and the team will be in touch with you and schedule a time to talk if that's what you want. I have a question here about tax credits. I know, Pascal, you're not a tax expert, but let's try this one. Like, for tax credits, is the personal retirement savings the new auto enrollment? Like,
No,
are they
no,
equivalent? No.
no. Auto enrollment is not classed as a pension scheme as such. And what I mean by that is when you pay into a pension, you get your tax relief. Auto enrollment is actually a top up from into your pension from government. It's not a tax relief. Auto enrollment is taken from your net pay, not your gross. It is completely, completely different. And you won't be claiming tax relief on auto enrollment. That's not a thing.
Okay, awesome. And another question here. I know this one might be a little bit tricky, but ballpark figure on to break out at a fixed rate mortgage with approximately like 1 year left.
There might be no fee. It depends on what your rate is. Depends on your lender as well. But I do know we do this quite a lot and we give a lot of advice on switching mortgages. And a lot of the time we're quite surprised when people go and ask the question that there isn't a fee. So I would say whoever you're with, give them a ring. Ask them, is there a break fee to come out of it? And also ask them what the rates are. If you're thinking about moving, let's first understand what your existing provider will give you because moving isn't always the right answer, even though a lot of brokers will tell you you should switch, switch, switch. Well, you should if it makes sense. It doesn't always make sense. Now, also, there's the question then about do you need extra dough? Like, what's actually happening? But certainly talk to your existing bank. They'll tell you if there's a fee.
Okay, awesome. And I think this is the last question. And guys, please, if any of you have other questions, please, like now is the time. So I have a question here. I have no mortgage, but a credit union loan at 7% with 5 years left and a credit card debt. Should I go to a bank and try to restructure this?
Jay, just read that question to me again, please.
I'm going to paraphrase here. So this person has a loan with the credit union at a 7% interest rate with 5 years left, so quite a bit left still, and credit card debt. And they're asking if it makes sense to restructure, maybe try to get a lower rate on this.
Well, a lower rate, yes. Whether you should put it into a mortgage or not, I don't know the answer to that because I don't have full
Yeah, I don't think
details.
the question is about mortgage itself. It's more
Okay.
like about restructuring that.
Well, first of all, the credit card debt's probably expensive. I would look to see if you could switch that to a provider. Now, in the Irish market, there's not too many people, not too many providers taking on debt. UK market's quite different where you could transfer it in and maybe get 12 months interest free. Here, there's only a couple of players doing that. So have a wee look. I mean, if you actually push into Google, compare credit card offers, you'll see in there who's doing this. Try and switch it to somebody that's doing transfer free for 6 months. And what we mean by free is that they don't charge you any interest. But the point then is try and get it paid off in that 6 months. If that's not going to happen, then I would definitely look at restructuring it. I would have a chat with the credit union and say, listen, is there a way that we could top up that loan to pay off the credit card? Because chances are, if the credit union's 7%, the credit card could be 15, 18%, could be 11%. But understand it first. But certainly if you can get, the cheaper the money, if you're trying to buy money, then the interest rate, the cheaper you can get it, the better.
Perfect. Yeah, I think those were all the questions. Thank you very much, Pascal.
Okay. Guys, thank you for taking the time. If you do have questions or queries, by all means, come back to us. There are tools available and we're happy to share them. Things like budget planner. Remember what I said, I do recommend that you actually write down your budget and your expenditures because it does sink into the head a lot better. So if you're looking for templates or any help around this, by all means, reach out to us. We're more than happy to actually help you around this. Definitely shop around mortgages. Definitely look at your insurances, your health coverage, even your house and your car insurance. Shop these around, guys. I mean, there are huge deals out there. Just get control of your dough, and then you're able to make informed decisions. And that's what we all want. So, guys, thanks for taking the time. Keep a lookout, and we'll be back next month with another story. Bye for now.